Welcome to the Sojourn Wealth Management Podcast. Thanks for tuning in. Andrew Kraft here along with Jeff Bronner, Corey Akins, and we are going to do another episode in our Investment Basics series. This one on debt management, or as they call it in some parts of the world, debit management.
I'm not familiar with those parts.
Me either. Is that like Georgia or South Carolina
somewhere
or
north of
somewhere?
here?
Yeah.
So in general, we'll kind of get to the I guess, precise definition of debt, but we also want to talk about the, kind of various types. There's the good, the bad, and the ugly type of debt. So Jeff, why don't you kick us off with kind of going over some of the good type of debt?
Sure, I'd be glad to. When we talk about good debt, kind of a general basis, we would, or metric that we would use to categorize this type of debt is...
He's still playing the good, the bad, and the ugly.
Is whether or not this debt is going to appreciate so much so that it would justify taking out the loan. One great example of good debt would be a mortgage. Typically, mortgage rates, historically speaking, float around 6%. And if you hold on to a house through various markets, you'll probably either break even or grow beyond that mortgage rate. All the while you get to utilize the asset in a personal use sense. Another type of good debt would be education for particular fields. When we think about, a young, recent med school grad having $400,000 in student loans, that might have some form of sticker shock, but what that cost is going to end up producing is, an annual salary of $400,000 a year. So you could see how going out of residency, going into whatever the profession, whether it be a fellowship or just general hospitalist or something of that nature, you'll be able to pay down that debt. And then from there, once the debt's paid off, you're going to be in a really good position. So it's kind of like how, is it an investment that's going to return good on what you're paying in order to invest in it? So
yeah, so those two examples, you're investing in a home that, like you mentioned, appreciates. God's not making new real estate, so to speak, and then in yourself with the idea that you'll make more down the road.
Right.
Great. So a couple of good examples of good debt. Corey, why don't you share some of the bad and the ugly?
Yeah, thank you.
Not talking about Alabama or Kentucky, but
Oh, speaking of which, we beat Alabama over the weekend in basketball, so that's good.
that is good.
I think what Jeff's talking about, those assets that you taking out the debt for that ultimately produce value. So your mortgage, you sell your home, it produces value typically over and above what you paid for it, or one of your greatest assets is your income, right? And so leveraging debt to secure a higher income, you see the theme, and that is that there's value associated with what the debt is accomplishing. In bad debt, you don't have that. So it's typically consumer debt where, think credit cards, and it's typically depreciating. So you go out, you buy $4,000 worth of clothes on your credit card, and you don't pay that off that month. Well, you just spent money that you're going to have to pay, and it's earning interest, typically at 20, 25, 30% on the credit card. And what you bought is actually depreciating in value. So you couldn't then go sell those used clothes, sneakers, whatever, and make back the amount that you put on the card plus the interest. So that's why we would categorize it as bad debt. The ugliest type of debt is like a cash advance, where people give you cash in advance, obviously, as the nomenclature says, and then they charge an extraordinary amount of interest on it. And typically, if you're going to get a cash advance in the first place, your income and cash flow is probably not in a spot where you can pay that back without incurring serious interest. And I think we'll mention this, but that's bondage, right? If you look at it, you're becoming, in a sense, a slave to the lender.
Mhm.
And it's hard to get out of that. Now, we're going to talk about some strategies to do that, but that's the bad and the ugly. And I think just a general rule of thumb, we would want to avoid those things.
Yeah. And I think a big part of managing that potential risk is having an emergency fund.
Amen.
We've talked about in a different episode of just
Another investment basics episode, right?
Yeah. Just have some cash that you don't have to, run to the loan
Exactly.
shark and ultimately worry about Rocky Balboa coming after you, and to
This
collect.
was pre-12 round
That's
championship
right. That's
fight.
right.
Okay.
So another thing I want to kind of mention though with good, bad, and ugly is maybe automobies. Because
Oh, yeah.
people I think have some strong opinions about that. And
Lanes,
kind of-
Trains, and Automobiles, right?
yeah, that's a good movie. But the car could fit into some of those different categories.
Right.
Yeah.
So maybe talk about that a little bit.
Well, I'll take the first kind of spot, and then Jeff can follow it up with the good piece. I think a lot of times people incur bad auto debt because they buy a car they don't need, and we justify it, right? Well, I need the new 2025 $55,000
CarPlay.
for a car. Yeah, right. And as soon as you drive the car off the lot, it depreciates, right? And you're immediately kind of upside down. And depending on what the interest rate is, I mean, it's not really an asset, right? Like, yeah, we all need vehicles to get around, but I think being wise and being strategic with what you purchase, it's the reason that I recommend folks don't get in love with the flashiness, right? You can drive. I know some of the wealthiest people I know drive cars that are 20 years old, and so I think that's a component of it. But I'll let Jeff talk about kind of the other side to it too.
Yeah, because there's nuance when you're making that evaluation. For example, maybe there's a young family and they want a reliable family vehicle to make sure that, the family's safe as they're running their errands and doing different things. And so they're looking at a modest car note that would allow them to get a reliable vehicle, but it's not going to be a huge wrench in the cash flow.
Yeah.
It's not going to be a sizable note or a sizable rate that's going to end up hurting them detrimentally. The asset's going to depreciate the second that they buy it. However, they're going to get a use out of it that's really valuable and really important. And so there is some nuance in how we navigate that. But I think generally speaking, one of the things that we talk about is that threat of lifestyle drift.
Yeah.
That loans and debt and can so often attract and entice us because it's like, oh, I can get this thing that I want.
What you're saying is there's a difference between the family of 5 who they have to have a family van that is going to be reliable, and that may cost $10,000, and that they don't want to drain their emergency fund. And so that, hey, okay, we'll pay a car note on that. The objective is different, right? The objective is I need to provide a vehicle for my family so that we can go
safe, reliable, and
exactly.
it's a minivan.
Exactly. Yeah, right. Cup holders galore, right? The other side of the coin is like the person who doesn't have, there's no objective like that. It's really just like, I just need to have the latest thing. And that's where you get into trouble, I think.
Right.
I think another type of the type of debt that might kind of straddle categories. Jeff, you mentioned education. Because if there is a student loan that maybe isn't progressing your career or future income, maybe that's something to be hesitant about as well. I remember talking to a person at UT who shared that they had over $100,000 worth of student loans to get their bachelor's and then master's degree that led them to a job that paid like $55,000. And that's just going to be a hard hole to get out of.
Yeah.
And so I think kind of, in general education is good, but also going to have to consider what's the end objective.
And just a point on that, Andrew, if that is you, say that is somebody listening and they're just the Lord can restore the years that the locust has eaten. And that's what makes it so important now to come up with strategies, because you may be that person who makes 60, 70,000 and has a lot of debt. The best thing we can do is, recognize, probably shouldn't have done that. We can't change that. Now, what do we do to move forward?
For sure.
And that's what we specialize in. So,
Yeah. No, that's a great point, and a nice probably unknown segue into the next kind of topic, that debt is a big component of the financial wellness metrics that we look at. And as we are offering financial consulting, we talk to folks about, where they are, kind of how they got there with the past debt, and then where they want to go, and help them kind of navigate that. So, Jeff, why don't you unpack a little bit some of those metrics that we look at and how debt affects kind of overall financial wellness?
Yeah. So when we're navigating the more nuanced situations, like does the young family take out a car note to get that minivan, or, would we advise somebody to take out a student loan for a particular career? How do we answer that question? How do we evaluate whether or not this is a worthy debt to take out? What we would do is look at one, where are they in the life cycle of financial planning? Are they a young professional? Are they nearing retirement? Those types of questions. What are the short-term expectations? What are the short-term goals? And then we look at different ratios, like when we look at net worth, what is the debt to total asset ratio? Is it appropriate? Is it in line with what we would want out of somebody in their 30s or in their 40s or in their 50s? How much income are we earning, and how much, and this again gets into throwing a wrench into the cash flow, are we going to be occupying too much of our immediate income to pay off this debt? If that's the case, then it might not be a good debt to take upon yourself. We might need to look for a couple year older van, or maybe reevaluate a different degree or something to that effect. So there's a couple different metrics, and those are some of them. And those are also the metrics that lenders will look at too. And so it's not as if we're just saying, hey, this isn't a good idea, but the less financially well you are, I don't know if that's the correct way to phrase that, but the less you are, the more difficult it's going to be, and the more expensive it's going to be for you to get that loan. It's just going to cost you more. So it kind of compounds upon itself.
Yeah. When I first started in the financial industry, working at a savings and loan, which is kind of like a bank in Texas, that was mainly the thing that we looked at when they tried to apply for a mortgage, was the how much that payment would be of their income, and then their total debt, how much all of that was toward their income, with the percentages. And there's kind of a rule of thumb, right? Like, you don't want the mortgage payment to be more than a fourth. You don't want total debt to be more than a third. So those are some rules of thumb. But I think it's also important just to kind of seek some counsel and a second opinion when you're thinking about getting debt.
I think those are good rules of thumb too, right? Like, just because the rule of thumb says your debt shouldn't be more than 25% of your income doesn't mean it has to be 25% of your income either, right?
Correct.
Like,
good point.
If you can have a home and it be 10% of your income, I'm all about making sacrifices in the short term for long-term wealth. Like, and that's ultimately what it comes down to, is those who build wealth live kind of, I don't want to say frugally, but they live and try to maximize their financial wellness through debt reduction and basically not keeping up with the Joneses is a good way to and
it takes time. There's that analogy that it's like a hockey stick. It's really long and boring, and then ultimately you see kind of making gains. So let's say though that someone's found themselves in a position where they have a lot of debt, and they have various credit cards and a automobile and student loan and a mortgage, and feeling a little bit overwhelmed and maybe buried by these different obligations each month. They can reach out to us. We can kind of go over some different options. So Corey, you want to kind of share some of those different payoff strategies we look at?
Yeah. So the first I would say, and probably the most common or heard about, is the snowball. And that's Dave Ramsey, I think, just made it more popular, maybe famous. Basically, you take the lowest debt, say you got 5 debt obligations and the lowest value one, you just work really hard to pay that one off. You pay the minimums on the other, and then you pay as much extra on this one as you can. And it's kind of just built in there to get a win, right? Like get a completion if we're talking about sports, or throw a strike in baseball. And that does something in the psyche to like encourage you. And basically,
endorphin rush.
Yeah,
gets
that's
you
right.
Moving.
That's right. Low hanging fruit, right? And then you take that, what you were paying, when you get that smallest one paid off, you roll it into the next smallest one, and you just work to get that paid off. So that's what he has kind of coined and made very famous. And the other side of that, though, is the debt avalanche, which is you do basically the highest interest rate first. You focus on that one, pay it off. It's typically slower. You don't get kind of that immediate endorphin rush or as quickly. And you just work your way down by interest rate so that you're not like most of what you're paying is going towards principal ultimately to knock out the debt faster. And then I would add, I like balance transfers on debt. So like if you say you have 2 or 3 credit cards that you need to get paid off, banks and companies will do this thing where they offer a intro APR. So like a 0% for 18-month.
Annual percentage rate.
Yep. Annual percentage rate. You just need to know it's 0% for 18 months or whatever it is. And you balance transfer the credit card. And then you have 18 months or however long the term is to knock that out without paying additional interest. And so you're knocking out principal. And then at the end of the 18 months, hey, maybe we can balance transfer again, or maybe we can do something else. But that can work while you're doing like snowball or avalanche, right?
Yeah.
And that's a common way I see folks do it.
And I think we wouldn't say that that's the long-term strategy, but that's a great way to kind of get some, like a pressure relief.
Yeah.
You know, like
immediate relief.
Yeah. Like, hey, I'm drowning. Okay, well, let's do this, consolidate this, get to 0. And then over the next, 12, 18 months, however long the time period is, let's put a plan in place and get some discipline and start knocking.
I'll give you another example. Roth or traditional IRAs. So Roth IRAs, you always have access to the principal you've put in. So say you've had a Roth IRA for many years, at least 5. So, we want to do that. But, and actually in this case, it wouldn't matter because your principal, what you have contributed, you can always get out. And if you've got a credit card that's 26, 28%, and, it's reasonable to say, well, why don't I just take this portion of the Roth and knock that out, because you can't beat 26% in the market consistently. And long term, it's going to be better that you don't have that debt. So that's another way we can do it. We can do it also with traditional IRAs. There's some other nuance there, but just knowing that like it's not like so black and white. There's options there.
And that's something that, is worthy of emphasis, to say that when we're talking about the ratios we mentioned earlier, and I appreciate your point, Corey, about just because that's the standard that we're looking at, you don't need to max out that standard.
Right.
But also there are other metrics. There are other benchmarks. There's other assessments that we're looking at. What are the short-term, mid-term, and long-term goals? And how do we put all of that together to answer this question of how does that factor into this specific problem? How do I handle this particular debt? Or how do I take advantage of this particular opportunity? And that's in essence a snapshot of what it means to assess and then apply financial wellness.
Yeah.
Yeah. And I think one of the things that we do as financial advisors is, with that kind of high level approach, we get down into the nuts and bolts and help folks get off this, carousel or merry-go-round where they typically are just paying the minimum,
right?
Or maybe a little bit more than minimum, but not enough. And they're just kind of barely scratching away at the interest, much less the principal. And they're going to stay on that for a long time.
And what helps with that is casting vision. So if you cast vision to say, okay, I want to be debt free, but it's not ever just debt free. It's like the letter of the law, right? It's not just that we don't do the thing. It's also that we do this in light of that,
it's
right?
defensive and offensive.
Correct.
Yeah.
So
this magnetic goal kind of
you eliminate debt, and what does that free you up to do? It frees you up to save. It frees you up to go and purchase a new vehicle at some point down the road without having to worry about the loan coming in, and it gives you more power ultimately to navigate your financial journey. So
yeah, because it's a specific purpose. There's this definition of debt management, I think is important if you want to share that.
I think so. Yeah, think about this kind of in the overall 30,000-foot view of financial wellness, debt management as one of the points of what we look at is the intentional process of handling, reducing, and eventually eliminating debt in a way that minimizes costs like interest and protects your overall financial health. So it lends itself to helping you from an overall
of interest. I think is a great way to put it. That is literally the cost of money.
Yep.
And so am I willing to pay this much to borrow money? Let's rethink that. Anything else before we wrap it up, guys?
Just wanted to mention too, we talked about Dave Ramsey, and I think it's appropriate to just kind of we live in a certain time, right? I remember being in Barnes and Noble and picking up a book of his, and in it, he was like, don't ever have a credit card. You can buy a house outright without credit and things like that. And I'm just like, man, that is tough. And thinking about kind of our current environment, I think it's okay to address it. Like, okay, we live in a unique time, and it's not going to be one size fits all. And I think that's the value that Sojourn Wealth Management adds, is that taking your unique situation and then applying general principles to that situation is ultimately going to be optimal.
Yeah, and so if you're listening and you find yourself in a situation where you feel a little overwhelmed with debt, or even just have some questions about how you can get to where you want to go, please reach out to us. We'd love to schedule just a free, no obligation meeting, and we can chat and talk about where you are, how you got there, and where you want to go.
Thank you for listening to this episode of the Sojourn Wealth Management Podcast. This is a friendly reminder that all content in this podcast is intended for educational purposes alone. Nothing in this episode should be treated as tax, legal, or investment advice. We encourage you to consult your financial professional for any of those needs. The securities offered through Kestra Investment Services, LLC, Kestra IS, member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services, LLC, Kestra AS, an affiliate of Kestra IS. Kestra IS or Kestra AS are not affiliated with Sojourn Wealth Management.